Hello, Michelle. Tariffs are dominating the news headlines. My question for you is, how does this affect the middle market companies that you lend to, as well as how you think about lending to them?
Well, tariffs have definitely been a current hot topic for everyone. We've gotten a ton of questions about this really over the last month as Trump began to raise the topic more generally. There isn't really a one-size-fits-all answer to the question. Every private credit portfolio is going to experience the impact of a tariff differently, depending on the manager's investment strategy and how they deploy their portfolios around that investment strategy. That being said, the lower middle market should be somewhat insulated from the direct impacts of tariffs on its borrowers. Smaller borrowers tend to be less likely to be multinational companies, so they're tied to the U.S. economy or even economies in certain regions of the U.S. Also, specifically for the FEAC portfolio, we invest in businesses that are high free cash flow, lower capex businesses that are non-cyclical, an all-weather investment strategy. So for example, our portfolio does not have a ton of manufacturing exposure that might be dependent on non-US supply chain. Our consumer exposure targets non-discretionary spending, and our healthcare exposure is not concentrated in self-pay borrowers or service companies. So much at this point is still unknown in terms of which tariffs will ultimately be implemented, what carve-outs might be granted, the length of time they will be active, etc. But if we experience a tariff environment for an extended period of time, the lower middle market is likely to be impacted indirectly in two primary ways. First, higher interest rates for longer. While we have adequate interest coverage in our portfolios, it's generally not a good thing for a borrower to be at elevated interest rates for an extended period of time. Second, our portfolio tends to be borrowers that are service companies or more people-intensive businesses. If the tariffs remain in place for an extended period of time, borrowers are likely to experience another round of wage increases. While this doesn't change our investment strategy, we're focused on underwriting to a recessionary environment, taking into consideration all of these factors.
I'd like to ask you about deal flow and terms. Has any of this uncertainty affected volume and some of the agreements that you're thinking about in this market?
Deal flow throughout Q1 2025 has remained relatively consistent with what we saw in 2024. We saw a return to more normalized M&A volumes as well as more normalized composition of deal flow. Instead of deal flow being driven by portfolio add-on activity, as was seen in 2023, we saw a return to deal flow being driven by new deals or new leverage buyouts. That continued into Q1 2025. At the same time, we get questions frequently about how we're seeing such strong deal flow in an environment that has been characterized as a relatively muted M&A volume environment. When you look at M&A volumes in the lower end of the middle market, they're driven by two primary sources. First, there's M&A activity between sponsors. We've all seen this deal flow be muted over the last couple of years. Second, M&A activity driven by entrepreneurs and founders selling businesses to private equity, so first-time private equity-owned businesses. This was really the driver of our deal flow in 2024, and it has continued into 2025. It's a unique characteristic of the lower middle market. In the last couple of weeks, we've all seen some broad public market volatility driven by the news around tariffs. That volatility has not made its way into the private markets at this point, and as a result, we've seen very little change in terms of deal terms. This isn't entirely unexpected. Private markets tend to be less reactionary than public markets, so it can take a more consistent or pronounced change in market conditions over an extended period of time to impact private market terms. Additionally, the fact that there's a fair amount of dry powder in private credit markets looking to deploy around quality credit might also extend the timeline required to see changes in deal terms.
Well, thank you very much for your time today, Michelle. Look forward to speaking to you next time.
Thank you.